Feels like the hits keep coming for the banking sector. Back in March, of course, we saw a couple of big banks fail. Investors got wiped out with Silicon Valley Bank and Signature Bank. And then fast forward to May, the same thing happened with First Republic. Now, here we are today. Feels like the hits keep coming for banks. We saw Moody's downgraded a bunch of banks a couple of weeks ago. Now we've got S&P downgrading even more banks. Investors have to be wondering, okay, is it finally time to just stay away? Should I avoid banks completely? I'm Jason Hall. This is The Smattering, and I don't think that's the case. I think there is still tremendous opportunity to buy banks, and we're going to talk about three banks in particular that I like a lot right now. But first, thanks to The Motley Fool for sponsoring our videos. We're going to talk about some great stocks on this video, but if you're looking for even more great ideas, go to our special link, fool.com/The Smattering. And The Motley Fool is going to give you its 10 best stocks to buy right now. So that's 13 great stock ideas you can get just from watching this video and going to our special link. All right, everything that's going on with banks, I want to sum it up in just a couple of sentences. The big thing, interest rates have absolutely skyrocketed really quickly. Basically, we've picked up 15 or 16 years of interest rate declines in a year and a half. Interest rates have moved up so quickly. It's frozen the housing market. It's slowed other economic activity. And it's created an environment that makes it harder for a lot of bigger banks, especially banks that already have big mortgage loan businesses, to generate the kinds of returns they've generated in the past. Part of that's because their loan books are not going to be growing as fast as depositors are going to be demanding higher yields. So that's going to squeeze their margins. Now, if you can pay the right price for one of those banks, I think it can work out fine. So for example, Truist Financial trading for between 70 to 80% of book value. That's a pretty decent discount, particularly if they can hold all of their loans and not have to sell any at a loss. Being able to pay today's prices should work out in pretty solid returns, even if the bank itself doesn't generate great economic results, right? Now, I want to talk about the banks that can actually generate good economic and financial results. So we highlighted recently Axos Financial on one of our videos. I want to make a pitch for it again, just to highlight what we've already talked about. The vast majority of its loans are either variable rate, meaning they're already adjusting up, or they're hybrid, meaning that they have a fixed period that then becomes variable. And within 3 years, half of their hybrid loans are going to turn into variable loans. So well over 90% of their loans are going to be variable rate. And they have a really long history of high quality risk assessment. They're really, really good at underwriting. So I believe that Greg Garrabrants and his team is going to make the most of the opportunity. They grew net interest income something like 50% last quarter. They're really, really built for this kind of environment. Two others that I've talked about in other videos before, but I want to highlight again in this bank-focused video. The first one is SoFi, the fintech that's become a bank. And if you think about its lending business, historically, it's been built on primarily student loan refinances and other personal loans. Now, the downside of these is they're unsecured, right? There's not a house or a car or some other asset that backs it. So on the surface, they are a little bit risky. The thing is that SoFi's done a really good job of building a book that's tied to people that have really high earnings, highly skilled, great credit scores. So it's built a little bit of a safety net to make sure that it has borrowers that can continue to pay those loans that it earns those higher yields on. But we have the end of the federal student loan payment moratorium here coming up. It's happening over the next couple of months in a phased way that they're rolling it out. And that's a massive market of refinances that's going to be opening up for SoFi, that's going to allow it to return back to growth in that area. So I think that's an area that's really attractive. Also, SoFi's mortgage business, I think, is really compelling. It's really small at this point, and this isn't the best time to be in the mortgage business, but it's a pretty good time to be starting in the mortgage business because you don't have all those 2.5%, 3.5% mortgages on your books. So that means that you can continue with the high yield online savings, 3+% yields to depositors, and then you can still write mortgages and make good money. That's hard to offer those kind of yields if you're a Truist or a Bank of America and you're only earning 2.8 to 2.9% net interest margin. So it's a really good position for SoFi to be in because it's unencumbered. And as they continue to add other services, other financial services, and other lending products, they're getting more sticky. They're becoming more integrated. They're offering more. And consumers tend to love it. Their products are really good and their online experience is great. So SoFi is one that I like. Another one that I'm a big fan of is Live Oak Bank. From a depositor perspective, it's a lot like SoFi. They really focus on high yield savings and CDs, online CDs for savers. The vast majority of those deposits are not above FDIC limits, so significantly reduces the risk of a bank run. that's how it gets deposited. So that's where the capital comes in. Now it lends those deposits out to small businesses. So it's a really, really appealing way to leverage one place to grow your deposits, to get the capital, and then lend it in a different way that's decoupled, right? So I think that's an attractive part of the business. The other part of it is that lending to small businesses, these are almost all variable rate loans. Again, as interest rates are rising, the yields that they can earn on loans, new issues, and their existing loan portfolio are moving higher. Now, Live Oak also has a really strong track record of lending into industries and to businesses that have the ability to pay and continue to pay and that are growing. The risk profile is very, very attractive, and it trades for a really reasonable valuation. So again, I think even in this environment where most banks are probably going to generate below average returns, I strongly believe that Axos Financial, SoFi Technologies, and Live Oak Bank are three that are built for exactly this sort of environment that can deliver above average returns, and you can buy them discounted broadly, certainly discounted versus their long-term averages, whether you're looking at book value multiple or you're looking at a price to earnings multiple